of minutes early here. So for those who aren't aware, there used to be a Sunday morning live around about 9 o'clock where we would kick off by discussing the Sunday supplement. I'm trying to carry these on as and when that I can on my own for the moment, although in future I definitely want to keep the door open to having a few guests. If you're listening to this on playback, this is a live recording, so there will be comments from people and various things to keep it fresh in real time. So hopefully that explains it. The supplement this week had a bit of a dangerous day yesterday where I had quite a bit of spare time apart from anything else. So there was a bit of ferrying kids backwards and forwards and things like that, which left me with room to do quite a lot of primary research and work on what happened this week, and also use, as I do, the supplement to try and crystallise my thoughts and then put them across, hopefully, to anybody who wants to read at length. It is a long read today. LinkedIn's got it at 42 minutes. I reckon this video will go on for about 45 minutes, if not a little longer. But I'm not going to apologise for that, because I think you can dip in and out when you want to, but also you need to get into these things in detail to really have any hope of understanding them. There's no point understanding these things at a shallow level. So I'll kick off. First of all, I do like to mention, of course, that we are running a property business workshop in London on election day. Yes, we did book it before election day was announced, Thursday the 4th of July. It's at Blackfriars. We're taking on, so I say we, that's myself and Rod Turner, host of the Rodcast. For anyone who doesn't know him, highly recommended podcast. I'm still sore about the fact it was the #1 podcast in property in an article that I read earlier this year, and Propenomix was #2. But don't tell Rod, I'm still working on it, and he's only got downwards to go, and I can still climb, of course. So, but in this workshop, we're going to be taking on the fundamentals of property investment, because we see people making so many mistakes about what the important metrics to track actually are in their property businesses. We're going to talk about risk mitigation and control. We're going to talk about a suite of investment metrics, because there is no one solid answer to that, one sole answer. And we're going to talk about differing secured debt arrangements, loan structures, and the big one, how do you scale your property portfolio or business? Why, when, and how? So that's at Blackfriars, and the link is at bit.ly/pbw/PBWTHREE. So this week's supplement I called Hold Me Now. That was maybe, if you're old like me, you might have the Thompson Twins ringing in the background of your head when I say that song title. But of course, it was a reference to the fact that the Bank of England did indeed hold the base rate this week, as I predicted. What happened that I didn't predict was I thought that one more person might cross the floor and vote downwards, but instead they went with some fairly clear language that they're really strongly considering a cut in August, I think. So the quote was, Bank of England decision was finally balanced for 3 holds, probably including the governor, which means it was a close run thing not to cut. August cut very much on, and that's from Faisal Islam, who's the BBC economics editor, and that was immediately after the rate cut announcement. You would expect Faisal to have a pretty good inside line on what's going on in the committee. So hello to those signing into the chat and saying hi, thanks. So yeah, you'd expect to have a pretty good inside track on it, and I think you'll see as I get into today's how I've also built a bit of a picture as to how we can draw some, I think, pretty solid info and predictions from what the committee have said. But it's not just going to be about August meeting, of course, and we'll get into that as well. So yeah, that tweet came out, or came out at midday on the dot on Thursday. So obviously a bit of inside info for Faisal, which I'm not privy to, but there we go. I'm going to get into the bank's mindset in the deep dive and the makeup of that vote, and also including what's been obvious to me since well before the election was called. The tinfoil hat ideas went away, as any idea that the bank would capitulate to help out their old mate Rishi sailed into the sunset as there was no cut. I called Q3 for the first cut at the beginning of this year and at multiple times since, and I'm not yet been proven right, but I've gone odds on. Let's face it, we've got 2 meetings in Q3 of this year. But before we get into that, we'll always get into the macro, and before that, the state of the union, or at least the state of the property market. So regular readers and listeners and watchers will know that I'm a big fan of Chris Watkin and his weekly UK property market stats show, which is well worth you having a look at on his YouTube if you don't already. So there's always a report on the week that ended last Sunday. It's as close to real time as you'll get in this game. Price on sales agreed for June have remained at £350 a foot. That's a record price per foot. Listings stayed 5% higher than the pre-pandemic market for the year to date. Net sales were 13.5% better than the same week of the year in 2023. So that the election doesn't really seem to have knocked the market at all there. They're still 4.8% higher than the pre-pandemic average, and they're 11.3 above the 2023 year to date. So that's how much better the market is in terms of net sales than last year, over 10% better, which is great. So we know that the market's going to hit new highs when these figures get to completion in Q4 of this year, and many will be left scratching their heads as to why it happened again and why they got it so wrong. I can't wait for the 2025 predictions, and we've only just got to the summer solstice. But anyway, on with the macro. We had inflation and all the associated, and you know that I won't resist a deep dive into that as well. We also had the consumer confidence figures and retail sales, which fit together quite nicely for some analysis. We had the flash PMIs for June, which I can never leave without comment. And you know that a week never goes by without me tucking into the gilt and the swap yields. So Wednesday's inflation figures went as a high level, just as I predicted. This wasn't exactly Nostradamus, although backing the broader consensus to be correct usually makes me remind myself that a stop clock is right twice a day. But let's get stuck right into it. The headline grab is always CPI. We hit that 2% target. That's the first time since July 2021. That felt good. And the less well-informed thought that might influence the Bank of England, who in reality had made their minds up weeks and weeks ago. It didn't. Spoiler alert. However, you know the detail is where it's at. So off we go. CPIH, that's Consumer Price Index, including owner-occupiers' housing costs. And you'll see where this still needs improving as I get into it. That was 2.8, down from 3%. A much more realistic measure than CPI of the whole cost base for the general public. Month on month, that was up 0.4%. CPI was down from 2.3 to 2, but it was up 0.3 on the month. Now, core CPIH. Now, I often talk about core inflation, and to be clear, what gets stripped out when you come to a core figure is not only food, which actually deflated on the month, and also energy, but also alcohol and tobacco. Now, core CPIH is still reading above 4%, 4.2 to be precise, down from 4.4. Goods were down 1.3, but services up 5.9, which is one of the figures that's still worrying the bank and me. Core CPI went from 3.9 to 3.5, which is a healthy drop. CPI services were down to 5.7, so CPIH services are still above those, and that number well above 4% really isn't healthy, nor is it falling quickly enough on the services inflation side. So OOH, the Owner-Occupier Housing Inflation Index, moved up to its new high in this cycle at 6.7%. That's the highest figure in over 40 years. So this is what the households are really seeing, and this big number is kind of made up of all the increased cost of housing for owner-occupiers, primarily manifesting itself via higher mortgage payments. There's still a runway for that to move upwards, and that is squeezing what households spend their money on. Sure, it ignores tenants, but we know that the cost of rent is going up for the same reasons as the cost of being an owner-occupier with a mortgage. We also know that the ratio of tenants with a landlord with a mortgage versus no mortgage is pretty much the same as the ratio of owner-occupiers with no mortgage versus having a mortgage. Now listen, some landlords without mortgages will still be putting their rents up, of course, but it's likely they're not being as aggressive with their rent increases as, apart from anything else, some of these rent increases from people with mortgages are to stop them going bankrupt or having to sell the property. So OOH being at a record high also speaks as to why the average household is still very much feeling the cost of living squeeze. This is one of the bits that Rishi doesn't seem to understand. So CPI is up 34% since 2015. CPIH is lagging behind at 32.7, but it's running hotter than CPI at the moment. And OOH is up 25.3 as a comparison. They're converging with their respective rates of change at the moment because OOH is up more than anything else. Food inflation was down 0.3 month on month. That's the biggest positive of these figures in many ways, as food inflation has well outpaced CPI and all measures of inflation over this recent period of inflation. And regulars will know I like to look at the monthly figures and sometimes expand those into an annual figure or a more realistic, more accurate real-time figure. Looking back a year is basically arbitrary, and sometimes things have changed dramatically, as they have in the UK, I believe, in the past 12 months. So core CPI, month on month, as an example. The last 6 months are plus 0.6, minus 0.9, which is very typical for January, because January we do see prices drop, of course, in January sales and things like that, and they're having to tempt the consumer's money out of the pocket. 0.6, 0.6, 0.9, and 0.5. So May is the lowest of the non-January figures for 6 months. But 0.5% in a month is still way too high. From June 23 to November 23, we only had one reading at 0.5%, and everything else was below that, with a minus 0.3 in November 23. Those figures are the next ones to be dropping out of the 12-month number, and unless core calms down rapidly, the headline figure is going to go up again, not down. So compare that to the past 6 months, which annualises to 4.7% for core. If you halved the January impact, as there's only one January each year, of course, and we're talking about 6 months, not 12, then you'd be looking at core close to 5% if we consider the last 6 months. You can see this is still uncomfortably high on a more real-time measure. The only solace that we can take is we've moved down to 0.5% for May, and that's the best reading since last November if we ignore January. So, stating the obvious once more, if we just look at the 0.5% last month and annualise that number, that would be very dangerous, of course, taking 1 month and making it into a year, but that would make core inflation 6.16%. I think high 4s looking backwards and 4 or just below looking forwards 12 months feels the most realistic. But having this discussion around 4% is not conducive to lower inflation. And remember, we will be able to swallow higher inflation. As I often say, I believe the government would prefer 3% to 2%. But it does leave us very fragile in the face of a shock. And the frozen tax thresholds will certainly keep any feel-good factor for the workers somewhat at bay. If we do that same exercise for CPI, since that's the headline rate the Bank of England is obviously tasked with managing and targeting, the last 6 months are plus 0.4, minus 0.6, but that's January, 0.6, 0.6, 0.3, and 0.3. Now remember, this has brought the energy price back into the equation, and the price of energy cratered in April 2024 for most households, and we still printed a plus 0.3. Okay. The PMIs, the darling of my real-time metrics, which we'll move on to later, suggested that May was one of the calmest months for price increases for some time, but we still printed a plus 0.3. That 6 month CPI annualised would be 3.2, which feels a lot more accurate than 2% does in real time. I think 3.2% and calming isn't a bad stab for the next 12 months, but calming slowly. So over or under 3% is the line to be betting on, not over or under 2%. Indeed, I've spoken before about how my own thoughts are that the target should be 3% at the moment. You would want to be wary of the effect this would have on the bond markets, because you would immediately devalue bonds, which would send yields upwards, so it would have to be tapered and implemented gently. There would be a way that no effort is being put into at the moment, very similar to the quantitative tightening situation, which I'm also going to take some time to talk about today. So if I just pick out a few of the 12-month inflation components of note before closing on inflation for this month, or maybe just for this week. Food plus 1.7 over the past 12 months, a great figure compared to what we've been seeing. Minus 0.3 month on month, fantastic news on food. Alcohol and tobacco up 7.8%, clothing up 3%, health up 6.3%, education up 4.5%, and restaurants and hotels up 5.8%. So you can see where the pressure's coming from at the moment. And if you go down one level, the wage changes in those sectors, which I analysed last week, you'll see that wage rises have driven an awful lot of these price rises. It's where that we go from here that will shape inflation significantly over the coming months and years. Okay, that's a lot of inflation, and that's enough. So on to the Consumer Confidence Index produced by GfK. This is more real time. This is June's number, generated on a survey done between May the 31st and June the 14th. So the summary, looking both backwards 1 year and forwards 1 year, consumers have a more favourable view. The overall print of minus 14 was ahead of the consensus and compares favourably to minus 17 last month, minus 19 in April, and minus 24 a year ago in June 23. The negative nature of it is a tough framing, but it averages a negative number over a long period of time. The Brits are perhaps just bearish by their very nature. The number was minus 49 in September 2022, after all. One slightly disconcerting point from the past month was that the only positive figure, personal financial situation over the next 12 months, went from plus 7 to plus 4. Is that reality biting, or is it reflective of the probable election outcome maybe? Or is it a fuss about nothing? We will see, but you'd think this would affect consumption. It's interesting though, because although the survey shows less confidence over personal finances, it shows a dramatic increase in hopes for the general economy over the next 12 months, from -17 to -11 in 1 month. And also the major purchase index looks as good as it has done for some time. So do the people believe that Labour will be better for the overall economy, but worse for them on a personal level? You can sort of sympathise with that way of thinking if you put parties and views aside, I'm sure. The savings index has also come down markedly, whether that's less money in the pocket meaning less to save, or just monthly volatility, but the election announcement looks to have either snapped off and reversed a few trends, or exacerbated those trends. The figures are much more volatile than they were in recent months, and the obvious variable that has changed is the election announcement. So nothing too damning for consumption really from this survey, I don't think. Less saving will help consumption, but more spending is inflationary, the classic rock and the hard place. Let me repeat what I posted on a LinkedIn comment this week. Wages up 6%, spending down 8% from a year ago, and that's nominal as well, and down 10% from January 2020. That's also nominal. That's a big real terms consumption haircut. Of course, more is going on mortgages or rent from the 2/3 of households that deal with them, although 70%-ish of those on 5-year fixes and longer are not yet dealing with that pain. There's a sting in the tail, but very little is over 6% over the past 12 months. What I mean by that is very little is ahead of what inflation has done over the past, is ahead of what wage increases have been, over the past 12 months. So things are improving, is my point. Context is important. The question is, when does it stop getting worse before it gets better? And so my point is, I believe we're past that point. If it's your month for your rent to rocket or your mortgage payment to go up massively, then it's your month. But the majority continue to creep forward since we have genuine real terms pay rises at the moment, whether you adjust for CPI, CPIH, core, or any other measure of inflation. And then retail sales feeds well into this discussion. The backdrop is we had an appalling April for weather and also on the basis that Easter was nudged into March. May was always going to look better, but the May figures were well ahead of consensus, with a 1.3% rise year on year and a 2.9% rise month on month. The consensus was that sales would be down nearly 1% year on year, so plus 1.3 was a big bonus, although of course that still sits behind inflation. So the moral of the story is that consumption hasn't cratered, but when you look at it in context, since 2019, volume of sales is down 1.5%. Value of sales is up nearly 19%, so below almost everything else that inflation has battered. Volume of people to consume is up around 3%, depending on which figures you trust, with some estimates in there because figures tend to lag. So per capita volume is down closer to 5% rather than 1.5% since 2019. People are still buying less than they were before the pandemic. This does leave room for growth as wages repair, although frozen tax thresholds will suck disposable income from the households, of course. Of all of them, the personal allowance hurts the most and is the biggest percentage differentiator. But changing this causes a major tax gap. Tough times for those running the books for the nation. So consumption has fallen quite a lot, but the overall trend in the now isn't clear. This is important because it is the cornerstone of Dr. Swati Dhingra's argument to cut rates, member of the Monetary Policy Committee. The noise around it means that in order to cross the floor, as it is known, the others likely to need to find a different reason. So what are the other stories? Well, unemployment upwards, although I do think that trend will calm. Economy slowing, that hasn't been the case on recent PMIs, but here are the June flash estimates. The composite output, the aggregated index, 51.7. Now that's a 7-month low, down from 53 in May. Services 51.2, another 7-month low, down from 52.9. Manufacturing 51.4, which is a 23-month high, and that's fabulous news. And output is up at 54.2 for manufacturing, which is a 26-month high. But you can see the direction of travel here. Services have slowed dramatically in the past couple of months. As always, though, we need to go a level down before we write the UK economy off. The survey did show the slowdown being partly driven by a pause in client spending decisions during the election period. We would need a broader analysis of previous elections to see if that held true in general. Worse news contained deeper in the detail, though. After a significant slowdown in inflation in the May PMI reports, which hasn't really fed to particularly low month-on-month inflation, as I've already discussed, June saw much higher transport costs thanks to severe global shipping constraints. So producers raised prices at the sharpest rate since May 2023. Customer demand for services was up. Manufacturers are expecting continued demand increases. There's also a dip in foreign demand for our manufactured goods from the UK. Employment overall sounds quite weak. I would interpret the report as saying employment has gone roughly sideways in June so far. And the resultant GDP output from the flash survey would be 0.1% quarterly. However, I wouldn't read too much into that because the election uncertainty impact here. Reserve judgment until next month, basically, but the economy certainly isn't roaring forward. The chief business economist at S&P Global, who produced the PMIs, has a fair turn of phrase. His name's Chris Williamson. In short, while a slowdown in economic growth may prove temporary, should businesses react positively to the policies announced by any new government, the stubbornness of underlying inflationary pressures above the Bank of England's target still looks somewhat ingrained. Okay. So just to close off the macro then with the yields, we had a sideways week here as well. Opened at 3.947, closed at 3.941. It doesn't come a lot closer than that. It was largely dull as ditch water. A solid trading week for the bonds, but there was a brief breakout above 4% again on Monday, and there was a trip down to test 3.85 on Friday before coming all the way back for the close when the PMIs were released with that data contained within it. 3.95 still feels too high to me, but not miles too high. The Thursday close was 3.908 and the swaps closed Thursday at 3.823. That similar reverse margin we've been seeing for some months now. That's good news and should see some more headlines about rates being clipped over the coming weeks, although lenders may well be deferring decisions about rates until after the election, and you wouldn't blame them. Mortgage rates with no arrangement fees for limited companies, sub 6%, should persist for a while yet, hopefully. Overall, I think the yields are still on the way down, slowly, but there are some suggestions of inflation gremlins in the PMIs that have me a little concerned. The bank will, of course, have seen half of this. The PMIs were out on Friday, and didn't have lots more to go on in their last meeting, to be honest. I was quoting 95% certainty of a rate hold, and that one did come to pass. I didn't get my 6-3, predicting that Hugh Pill would cross the floor. They've held the vote of 7-2, which was a mirror image of the last meeting. I'd already discussed the realistic response to the election from the bank was not to cut the rates. It looks too political for an independent central bank. Either way, I don't think they were really leaning towards the cut anyway, just yet. Also, don't miss this nuance that the Deputy Governor for Monetary Policy has now done his last meeting and will be replaced by former Treasury Advisor to Jeremy Hunt, Claire Lombardelli, in the next meeting, which is in the first week of August, by the way. My own tinfoil hat theory that she was sent in to get rates down before the election is now up in flames because the election was called earlier than we all expected, of course. Still, she's now the one that Andrew Bailey will listen most closely to, and there is no real information at the moment as to whether she will be particularly hawkish or dovish. We'll find out. What are the most important parts that the bank pulled out of the data? Inflation at 2%, of course. They still believe it will rise towards the end of the year, and without a consumption collapse it will, in accordance with the analysis that I've already given you. GDP stronger than expected, but business surveys indicating a much slower growth rate of around 0.25% a year. On June's PMI, that looks about right. Sorry, 0.25% a quarter, that is. That's about right on June's PMI, but will there be a post-election flurry of confidence? Unemployment is difficult to trust, loosening, but tight by historical standards. They've wheeled out this rhetoric for at least 9 months now. My personal view is that the pace of job losses has slowed right down, and we are likely near our top unemployment figure for the year. But in reality, economic inactivity is a much bigger problem, although we're going outside of the bank's remit there, so we don't need to be too concerned about it. Services inflation isn't falling as quickly as they thought in the previous meeting, so that's an issue, of course. That is strange because they seem to model a massive increase in minimum wage. They seem to struggle to model a massive increase in minimum wage, feeding through into higher services prices, which of course it was always going to. I really don't know why they struggled with that quite so much, but there we go. And then the past month's been a good result, but month-on-month services inflation is deep in the ONS reports, which is really silly, given that it makes up about half of all inflation, but there we go. Sometimes I think that people are too scared to challenge the establishment. I suspect this is why I've never tried to work there. I'd last 6 months tops because I'd be too disruptive and ask too many difficult questions. I am seriously consultant-only material. There's a reminder that the 2% inflation target is medium term, and what they mean by that is 3 years. There's no update on the last report because full reports only happen quarterly for the bank. Again, I don't know why that is. But the 3-year number prediction was 1.6% last time out. So obviously, apart from anything else, below the target, which is good for people and good for the economy. It may not have changed much because, again, inflation has looked a lot more persistent than the bank forecasts. But then there's a veiled ending to their summary in the minutes. Best repeated verbatim. As part of the August forecast round, members of the committee will consider all of the information available and how this affects the assessment that the risks from inflation persistence are receding. On that basis, the committee will keep under review for how long the bank rate should be maintained at its current level. Now, that's very much been interpreted since the meeting as we're cutting in August, or at the very least, the door is wide open for an August cut. It's definitely the most dovish statement we've had in this cycle, of course. There's no doubt about that one. It also says to me that we don't do much on these meetings in between the full reports, which is a bit frustrating for those waiting for a cut, for sure. My specific technical feelings are that inflation is still more entrenched in the system than anyone is willing to talk about or realise. However, I live in the real world, and in the real world I know that a cut is important for business and important for consumers to show some hope. That hope will then be dashed, assuming August is a cut, when we get to September's meeting, and that's a hold, because some will assume the start of cuts means very regular cuts, and I don't think that it will. The preferred path by the bank is much more likely to be quarterly or even 6-monthly cuts, and not down to a particularly low level. I'm convinced this is the correct thing to do, all else being equal, but you can't just set a strategy here and then just follow it without tweaking in the face of the data. The data is varying and difficult and needs to take into account fiscal policy changes that will be coming after the election as well, of course. I do still feel much more positive than many of the commentators about the UK growth rate, though. Some are still maintaining 0.5% for this year, which is just lazy, or not looking at the real-time data, frankly. Even that 0.25% per quarter, which I feel is too low, is just a little bit over 1% for the year, thanks to compounding, and slightly more than double these bearish forecasts. National Institute of Economic and Social Research's 0.5% for Q2 now looks too enthusiastic, and I think 0.4 would be closer to the mark. However, 0.6, and what will happen when that 0.4 comes out, or even if it's 0.3, the election announcement will be blamed, by the way, so let's just predict that one in advance. However, 0.6 Q1, 0.4 Q2, let's say, 0.25% Q3, 0.25% Q4 would still see us above 1.5% for the year, which would be treble those bearish forecasts, and it's very, very doable. So the bank does note the changes since the last meeting in terms of oil moving back upwards in price, back over 85 a barrel now, continued shipping disruptions, as has been already cited in the PMI data, and international inflation coming in slightly less hot than expected as far as CPI and core is concerned, although their downside misses in places like the US and the Eurozone were very marginal indeed, or even non-existent. They also note a stronger sterling, which gives further room for cuts, or at least for divergence from the US bond yields if there's yet more inflation stuck in that system, as I think there is. They also note a very steady and sustainable credit growth, which has to be a positive. The bank also makes the argument that the strong H1 for 2024, well above their forecasts, balances a weaker than expected H2 of 2023. And that's true, but it doesn't change the fact that their previous reports from 2024 all knew what had happened in H2 2023, and they didn't amend their models accordingly. They also note house prices and housing investment, which they discuss very rarely, the bank actually, so I'm always very interested, of course, when they do, are moving upwards in Q1, suggesting that the market is coping with the higher rates, which seems true, and don't forget how much lower the current rates are than the high points of 7% or so. I'm talking about the bond yields there when they were really going crazy. And even the resi stock mortgages for owner-occupiers was drawing an average rate of 5.34% in November 2023. So that's the rate at which new mortgages are drawn down, just to be clear. That was the high point of the cycle, as the lettuce worked her way through the system, even though she was long gone by then. That rate is now back down to 4.74, and whilst a dramatic increase on the halcyon days, that 60 basis points of repair is significant and should hopefully persist downwards slowly, as I've been saying. The bank quotes household consumption up by 0.2% in 2024 quarter one, which is likely ideal in the current circumstances. They can't say things like that, but I can. We could always do with more growth, but we do want to put this inflation fire out once and for all, and runaway consumption wouldn't be helpful at this stage. The change in major purchase attitudes, although, as always, we need more data, will be interesting to note in the consumer confidence figures for next month. Business investment was also up 0.9% in Q1. These indicators all seem to point to a lack of need to cut rates, to be honest, but I'm betting on the message that they want to send, combined with the fact that 6 to 12 months is the period we're looking over, not what happened last quarter. So around 40% of all wage settlements annually take place in April, but their expectation of just over 5% annual wage growth for Q2 always looks silly. We knew minimum was up 9.8 for a start, and it still does look silly in the face of the fact it's hardly come down at all from the 6% level it's been at, basically, for months. Here's where we really get into the meat, though, and have to read between the lines and try to be objective. First of all, there continued to be a range of views among these members about the extent of accumulated evidence that was likely to be needed to warrant a change in base rate, and the degree to which incremental information was leading them to update materially their assessment of inflation persistence. And I'd expect that, right? It is hard. It is really hard. There are very few times when all the ducks are in a row and everything points in the right direction. It is really educated guesswork to an extent. You'd also expect there to be a difference of opinion, which the bank works hard to drive and actually celebrates, and it talks about, unlike the Federal Reserve, where they just like to pretend that everyone agrees with each other when they absolutely and definitely don't. So then the bank says, for some members within the group, so we're talking about the committee here as a whole, right, 9 members, remember, the return of headline inflation to 2%, while welcome, was not necessarily indicative of the required sustained return to target. And you'd have to agree with that sentence. But continued high levels of and upside news to services inflation supported the view that second round effects would maintain persistent upward pressure on underlying inflation. Wage growth had continued to exceed model-based estimates. Indicators of domestic demand were stronger than had been expected, and the risks to outlook for activity were skewed to the upside. For these members, more evidence of diminishing inflation persistence was needed before reducing the degree of monetary policy restrictiveness. Now, what would be nice if we knew who these members were, of course, but I think I know, right? I think that's your hawks right there, right? Catherine Mann, Jonathan Haskell, Megan Green. Probably Megan Green. Maybe, or at least she would agree with the majority of that paragraph that I've just read. They want more data. The risk is staying too high for too long. They know this, but they balance the risks, of course, in their decisions. And then we have, for other members within the group, the upside news in services price inflation relative to the May report did not significantly alter the disinflationary trajectory that the economy was on. We know this is what Swati Dhingra will think. Absolutely, she's openly said this a number of times. This view was supported by evidence that recent strength in services inflation included regulated and indexed components of the basket and volatile components. The impact of the increase in the national living wage this April on aggregate pay growth was unlikely to be as large in future. Such factors would not push up medium-term inflation. For these members, the policy decision at this meeting was finely balanced. Now that key phrase there, finely balanced, means they're ready to cut next meeting, or they're certainly very ready to strongly consider a cut. And that's pretty much just about where I am, actually, or at least the position that I'm closest to. I kind of straddle those two positions a little bit, but I lean towards that one for more pragmatic reasons, as I've laid out. The country needs a break and a signal. The impact won't be as large in the future of these minimum wage increases. My preference would be to lay that out as this is not a wage price spiral at the moment. The reason that isn't is because people are catching up with inflation and not ultimately finding themselves with more money in their pocket in real terms at the start, in the middle, or at the end of the month. That is harder to evidence, so that you could look at real household disposable income per capita, for example. It is possible to evidence. And it's not an institutional view, of course. It's more of a street smart view because I'm more of a street smart operator. Andy Haldane would have agreed with this, though, I'd like to think, when he was the chief economist at the Bank of England before Hugh Pill was. So that group, I think, contains Andrew Bailey, the governor, Ben Broadbent, the deputy governor, who, as discussed, is leaving, but I would expect Lombardelli to slot right into that group immediately, Sarah Breeden and Hugh Pill. And I think it almost sounds like they know things are on the way down, they feel very confident, and they're ready to cut. And that's in line with the August cut, if I've got that right. Then we've got the two doves, the ones who voted downwards. So two members preferred a 0.25% percentage point reduction in bank rate at this meeting. For these members, bank rate needed to become less restrictive now to enable a smooth and gradual transition in the policy stance and to account for lags in transmission. CPI inflation had been on a downward trajectory for some time and had returned to target in May. It was forecast to stay close to 2% in the short term, consistent with the further easing in the labour market, forward-looking indicators of inflation and pass-through, and continued falls in inflation expectations. Given the subdued outlook for demand, the risks to inflation remaining sustainably at the target in the medium term were to the downside. Now, these downside risks I do struggle to see, but I could be having some blindness at this stage. The gremlins are still in the machine, and real terms pay rises are helping to bridge consumption gaps, or in other language, consumption's already fallen, as I've said, really significantly in real terms when you look at what I said earlier on. So it should repair, and it should be repairing from here, not falling. Where I can agree is the lag in transmission, for sure. These guys see inflation staying closer to 2 than 3, whereas I'm at a shade over 3, simply based on the most recent 3 and 6 month data and the PMIs. There's always, in a world of geopolitical risk, and an economy like the UK, which imports so much, including energy, right? There's always more upside risk than downside risk, or that's how it feels to me in the middle of 2024. Anyway. So they closed the meeting, thanking Ben Broadbent for his 128 meetings on the committee. That's a lot of experience to walk out the door, but Lombardelli is no slouch and has a super CV, and I'm sure there will be continuity at the bank. Ben Broadbent was on the committee for 13 years. He did very little for the first 5 because there wasn't a lot to do with the rate. A bit of QE, of course. Dropped rates when the referendum came, and then around 2019 it got a lot more interesting, and then a lot more interesting again in 2020, of course. Sounds a bit like a cricket test match when I put it like that, doesn't it? So that should make it clear in detail why the bank has done and is doing what they are doing, and the likely cut in August 2024. Don't expect yields to drop 0.25% when they do it, though, although if the PMIs are better in July and look more steady, it's possible we'll be at about 3.7 for the 5-year at that point anyway. Let's see. As the meeting draws closer, it already gets priced in, and lenders often hold off on cuts, so they look like they're following the base rate, but not really. I'd expect cuts closer to 0.1 to 0.2% rather than the full 0.25% from where we are today. So, there's one more bank-related discussion point that I want to get into here, and it is a biggie. In a way, we're indebted to the Reform Party for making a point of this. We've seen this week that Farage is most likely a Putin sympathiser, which we sort of knew anyway, and the more light that gets shone on him, the more chinks that will appear in that armour of bravado. However, Reform has raised a good point, even if their solution is a little bit Swiss cheese. As always, there's a third or a fourth way that no one seems to be proposing or talking about. I find that incredibly annoying in the extreme, and so I'd like to use the little platform that I've got to try and talk about it, given that no one else seems to want to try and even remotely solve this problem, even though there's billions of pounds at stake, which is just ridiculous, isn't it? So there is some fairly sensible commentary about all of this, although because Farage is so divisive, it tends to take one side or the other. I'm not a big fan of Nige, but I do think that A, it's a good idea to have the odd disruptor in Parliament, and the country is a better place for it. Same way I look at a George Galloway, for example. And B, I can be relatively objective and non-partisan. I've practiced that approach over many years. Better to be right than to like the outcome of your analysis is the phrase that I live by in Propenomix. So what's the backdrop? Well, you know the phrase quantitative easing, QE, came to prominence in the UK in the wake of the 2008 Great Financial Crisis. But what is it, right? It's the central bank printing money, or in today's world creating money, to buy assets. What assets? Government bonds, for a start. We, as a nation, stuck to QE for buying government bonds almost exclusively. 20 billion at one stage did get out the door to buy some commercial bonds, but when you think we did £1 trillion worth, that's obviously only 2%. So, largely speaking, we stuck to buying government bonds. So here's how the Bank of England describes it relatively simply, albeit in a way that could put them under attack. Shows how many people don't read the website of the Bank of England. Here's an example. Say we buy £1 million worth of government bonds from an asset manager. In place of those bonds, the asset manager now has £1 million in cash. Rather than hold on to that cash, it might invest it in other financial assets, such as equities. In turn, that tends to push up the value of equities, making households and businesses and other financial institutions that own equities wealthier. That makes them likely to spend more, boosting economic activity. Higher prices for corporate bonds and equities also lowers the cost of funding for companies, and this ought to increase investment in the economy. Now that is really, really interesting, because I can tell you for free, there is no way they would have written that in 2009, no way in a million years, because they didn't see what was going to happen from QE in the way that it played out. But what they've basically admitted there is they've given people who already had money more money. And of course, realistically, there are some of us who took advantage of that cheap money stage really significantly. The entire private equity industry would be a good example. So look, obviously it's pretty accurate. It's the Bank of England's definition. Although making people wealthy, boosting economic activity, it just didn't really work like that. It just made those people more wealthy, and there was a minimal boost in economic activity, and it gave them a platform to try and take more money from the pockets of the wealthy, who, you know, the top 1% pay nearly 30% of the tax now. Very popular to think that they don't do that, they don't pay any tax at all and all the rest of it, but generally speaking it's just rhetoric. Look at HMRC's figures if you want to know the real answer on all of that. But in reality, a lot of this was a bit of a wealth transfer, lending money at super cheap rates to those who could afford it and were good credit risks. Now, I'd like to think that I knew that at the time. I think I did in a way, although I was slow to the party, years too slow to be honest. But my point would be, when you understand it, you either play the game or you don't, because you aren't going to change the system. Is that defeatist? Maybe. Or is it just opportunistic? In which case, definitely I'm guilty as charged. You would expect the bank to be able to explain it relatively easily, because they are quite good at that. Indeed, QE did lower that cost of funding for a long time. The relatively simplistic logic, once rates started to go up, that came from the bank was, QE is not needed anymore now, because we're using QE as a secondary tool. We're using our primary tool, which is the interest rate. We need to look into that a bit more, I think. So here's the rub. Those bonds were purchased when bond prices were incredibly high, when rates and yields were incredibly low. They then continued to get lower and lower and lower over the course of the 2010s. So selling them off when you don't need them anymore leads to a significant loss. The alternative is just letting the bonds mature and not crystallising that loss, although that's not the only alternative. There'll be a bit more on that later. But let's dwell on that for a moment. They bought bonds with nearly no interest and therefore pretty much face value. Call it £1,000. Those bonds paid tiny interest coupons, £1.25 a year, something like that. And that money's paid from the Treasury to the bank, who are underwritten by the Treasury. So therefore, it's not a real transaction. It's not money that's coming out of the taxpayer's pocket, right? If you then sell the bonds when the yields are more like 5%, as they have been, that's an annual coupon, effectively, or an annual gain to the bond's value of £50, or a loss of £50 a year if you're the seller. In reality, you don't actually do it and pay the £50 a year. Instead, if you bought it at nearly £1,000 and then there's 3 years left to run on the bond, you only receive £850 back for that bond, and that crystallises a 15% loss. The maths isn't exactly correct there, but it's very much close enough for the purposes of this explanation. So on £1 trillion worth of QE, that would be 150 billion. And that does come out of the taxpayer's pocket because these bonds have been sold to other people. So if you think about this like I first did, why the hell would you do that? Well, it takes money out of circulation. And one of the big problems over COVID was how much extra money went into circulation via the most extreme form of QE, straight to consumers or small businesses via furlough, grants and COVID loans. This leaks straight into the real economy and is spent, because that's what the smaller economic agents do, and it leads to inflation. It led to inflation in property prices for a start. Burning money rather than printing it reduces the money supply and reduces inflation. And that's true, but at what cost, right? What does happen when QE is over or in the unwinding stage? Well, that's where the bank gets a little sketchy. The words uncharted territory spring to mind. There's no real consensus on whether QE in its first pure form was really inflationary or deflationary. Now, asset price inflationary, Yes, absolutely correct. CPI, typical consumer inflation or deflation, different schools of thought. And if you look at inflation over the 2010s, after the sort of crisis period had washed out, it was relatively normal. But where would it have been? You would think it would have been lower if it hadn't been for QE, because the economy wasn't doing great stuff. But of course, we did have some other events like the Brexit referendum, which changed the exchange rate, and things like that we have to consider. But look, my point is, economists can argue over that, and it's a position that's not necessarily a surefire one. We don't know what would have happened without QE, because we had QE. So most would agree it wouldn't have been pretty, but it comes a question of how much and when to stop, and then how to stop. The bank does address the inequality point as well that has been made since the first uses of QE, with a working paper that looks at the economy between 2008 and 2014. That's the most recent one they've got on their website. Too out of date to even bother discussing, because there's so much water under the bridge since then. So, now bear in mind this unwinding stage, or quantitative tightening as it's known, can lead to two possible outcomes. There's a sum of 7 lines of text on the Bank of England website about this, almost added as an afterthought. The process of unwinding QE is sometimes called quantitative tightening, or QT. This can be done by not buying other bonds when the bonds we hold mature, by actively selling bonds to investors, or a combination of the two. Quite simple. Massive difference between those two options though, which I'll go into. Unlike QE, which is used to reduce interest rates and therefore support inflation, the aim of QT is not to affect interest rates or inflation. Instead, the aim is to ensure it is possible to undertake QE again in the future, should that be needed, to achieve the inflation target. Now, when would you need QE again? Well, you would need it if you couldn't drop rates significantly. So QE, really, generally speaking, has only been needed when rates are already on the floor, right? Now, they might try something different. They might decide that actually not 0.5% wasn't very good for the economy over all those years, including things like inequality and thinking about the broader populace, and might decide that actually at a 2% base rate or a 1% base rate, they might decide to put some QE into it. So, they link to the August 2023 MPC report to talk a bit more about QT. That's all they've got on it. And all the 2023 report says is we're doing some QT, which was not particularly popular at the time, and it certainly wasn't popular around the time of Liz Truss when they were talking about it. They seemed to just ignore what was going on. It was just nuts, absolutely nuts, but there we go. So, if I put into context the expected bill from selling bonds rather than waiting for them to mature, is to the tune of something like £100 billion. Underwritten by the Treasury, remember. Does it seem like 7 lines of text is enough? It seems like a conspiracy of silence to me. I think it's a disgrace, and it makes me about as angry as I get about this stuff. £100 billion of taxpayer money. That's why reform piqued my interest when they brought up the subject of QE, not QT, sadly. I'm not convinced that anyone in the party remotely understands this, aside from Richard Tice, who's chairman and minority shareholder of the company. Here's their argument. The 700 billion, or just under, that's still outstanding, is sitting in the commercial banking system on deposit with the Bank of England, getting interest. Now look, they are fundamentally correct, they're sort of correct about that, but between 2009 and 2021, it wasn't a big issue. Base rate was 0.5%, went up to 0.75% at one stage, went down to 0.1 at one stage. Interest money being paid on that money was only 5 billion a year. Now, stop for a minute, right? That's not free money for the banking system. Yes, it feels like money for doing nothing, but they need reserves, of course. And what it did is it enabled them to operate their businesses at lower margins on saving and lending. If you took that all away, a good chunk of that loss would be absorbed by those who still use the banking system, which is all of us, right? Margins would have to increase. So as it stands today, savings rates would go down and borrowing rates would go up. Yes, up, so sound the klaxons. What would that look like? Well, you know I often go on about this 2% margin that the banks look to charge on top of the SONIA swap rate. That might have to look more like 3% margin, or even 4% margin, and that would of course be problematic. So, like every idea, there's no way that it's a victimless crime. I think one of the helpful ways to think about this is like it's a subsidy for the banking sector. And look, I'm not saying it's not too large. I absolutely believe that it is too large. What I'm saying is the idea of just taking it away and saving 30 or 40 billion, which is what Reform have said. I mean, we live in a world now where you can say things to the nearest 10 billion quid, and that's okay. It's just nonsense, and it would have significant consequences to people's pockets. There'd have to be a taper, there'd have to be good solid communication, and there are other options. Here's what the European Central Bank do, for example, because they've got the advantage of being quite young. So they can, and they have, learned from other people's mistakes first of all. It's got 3 reference rates, the middle of which we normally talk about. These are those rates. First of all, the interest rate on main refinancing operations, which is the rate that the banks pay when they borrow money from the ECB for 1 week. The rate on the deposit facility, which banks can use to make overnight deposits with the Euro system, and the rate on the marginal lending facility, which offers overnight credit to banks from the Euro system. And guess what they've done, right? They've introduced their own margin. Much lower than the commercial banks' margins, of course, because they're not a profit-making entity. Also, they're the only game in town to an extent, so they've got all the volume. But right now, the rate that we talk about at the ECB, recently cut from 4 to 3.75, is the rate that they pay on the deposit facility. You want to borrow for a week, Mr. Bank? 4.25 per year, actually. You want to borrow overnight? 4.5 instead. That's a nice bit of business, isn't it? Why not replicate it? Well, because no one has cared enough to try and make that happen. It isn't their money. It's classic public sector behaviour, and again, it's frankly shameful. Gordon Brown is talking about this at the moment, which he's got some stones to do that, to be honest, given that he was the Chancellor for 10 years, overseeing that independent central bank, and now he's seeing it another 17 years later. But his argument does have, if we put that to one side, his argument does have some merit. So the current level of commercial banking deposits with the Bank of England is 750 billion. That's conveniently close to the level of QE, although if it was withdrawn overnight, the 700 billion, the banks would scramble to recapitalise and be calling in loans all over the place. The chat from Reform makes people very nervous because they never talk of how it would be done, because they don't know and they don't care. Like all super populists, they just want to say popular stuff. But let's be really honest though, brass tacks, it would save money. Gordon Brown's the only one who's been vocal so far. He reckons about 3 billion a year, which is not to be sniffed at. It's not very ambitious though, what he is looking to do, and it's not particularly disruptive. So, could someone perhaps advocate for something a bit stronger, which could bring more money in, but not quite reformy, which would bring the house down? How about it? Well, I'm going to have a go right now. So, what if the bank's got a small operational premium on their average rate deposit for deposits made with the Bank of England? Let's say 0.5%, maybe, right? You'd need better inside knowledge to know what that would be. Now, I'd want to set this 0.5% that would cover costs. It wouldn't cost profits, or it wouldn't. Why? Because we want, as a nation, that money to be out in the field, earning interest, lent to businesses, lent to consumers, in order to generate and create more opportunities and more money, right? So, here's an example. At the last count, sight deposits, this is what the bank calls them, those are instant access, basically. Those are what you can see right now in the bank, and they're live, or the building society, and they're live, right? They're being paid at 2.12% across the banking sector on average. So my Bank of England would pay 2.62%. It wouldn't pay 5.25%. Why am I going after sight deposits? Because the ability to take them out overnight is matched by the ability to take them out the central bank too. Longer term deposits are getting better rates, 4.4 at last count. That's too high, and that's being subsidised by the QE rates. This should be at gilt yield minus operational and profit margin by the banks. We can't and shouldn't tell them what to do, but what I'm saying to you right now is QE paid for by everyone in the tax-paying system is subsidising those with money that have got it in savings accounts, and that cannot help with inequality apart from anything else. So, to borrow over the shorter term costs either base or gilt yield plus operational margin, the higher of the two. So that right now would be 5.25. So now we've got money on deposit at 2.62, right, and we're lending it out at 5.25. Well, a nice bit of margin for the bank that can try and make a profit instead of burning tens of billions of pounds of the Treasury's money every year at the moment. Seems pretty good to me, and most importantly, it aligns incentives, right? The banks don't want that 2.62 because it's rubbish. It's half what the 5.25 is, right? They've either got to put their savings rates up, but then they've got to find margin to do that, or they've got to get more loans out the door at well above 2.62, right? It would drive a lot of activity. Now, look, commercial banks have got to keep sensible reserves, but we shouldn't have a system whereby they can sit making money, not doing their jobs. The profits have to come from doing what they're supposed to be doing, and the government's role outside of the Bank of England oversight is to ensure they can provide support, grant funding, badly named wealth funds or the likes, in order to incentivise the people on the ground to take the risks and get the rewards. So, my savings would first of all live between that 3 billion Gordon Brown and the 30 billion reform number, more like 15 billion a year, something like that. But most importantly, they wouldn't upset the apple cart either. It's almost like a windfall tax on the commercial banks, and you could in a way achieve the same revenue raise with a windfall tax, but it sends negative messages and it also doesn't solve the problem. It just sweeps up until the next problem happens. But the argument for a windfall tax, if it worked for the energy companies, the exact same argument worked for the banks, because this increase in rates has massively contributed to their profits. So, the reform fear here, right, is that they say 30 to 40 billion, they assume 40 billion, then they make all these promises with the 40 billion. If you implemented that in one single policy badly, bond yields would go over 6% and probably over 7%, right, overnight, and that would not be good. We're talking double the impact of a Liz Truss budget, quite literally, when you look at all their policies and what's unfunded at the moment. And then you look at a sensible independent think tank's assessment of them, or perhaps even my assessment of them. It's also the case that when you need to look at the other costs when you change anything, rather than just pushing things around on a spreadsheet, which the public sector does at a professional level. So, anyway, in summary, I like the challenge of reform. I like the subjects being raised, but these aren't the people to do it at the moment. It's like some of their energy policy. They're dead right. Nuclear has to be a part of any sensible solution going forwards towards 2050 and beyond. And I hope that some of the other parties would adopt some of these policies, but make them a bit more robust, flesh out the detail, and not just do something that might smash the system to smithereens again, and actually make a difference with them, not just because they sound popular. So, here's another alternative for consideration. I don't want to keep going because we've got to a serious length now, and I don't want to present this as the answer. These are just some more detailed and granular strategic ideas for us getting to a sensible place, right? This isn't necessarily the answer, and it would need a lot more critique, iteration, and work, although that should be done publicly, not behind closed doors. How about this, having studied the yield curve far too intently for the past couple of years? I've spoken at times openly about my views on the pricing of various gilts and resultant yields. I focus on the 5-year, as regulars will know, because we take 5-year fixed mortgages, as a rule, in our portfolios. However, if you remember what happened in any level of detail after the Liz Truss budget, in spite of just announcing quantitative tightening, the bank was forced to intervene in the bond markets, particularly on gilts of longer duration. These gilts above 10 years in duration are much more lightly traded, and the pension funds were invested in leveraged LDI, liability-driven investment funds, that were losing value because the bond prices were plummeting and the yields were rising. There have been points over the past 2 years, which would include late September, early October 2022, but also the middle of 2023, when those longs, particularly the 30-year, have traded above 5%. I've said consistently at these points that price, or that yield, is utterly ridiculous. Right? That's best thought of as an average. For a government-backed investment to pay 5% each year, effectively, for the next 30 years, it would have been dismissed as utter fantasy just a few years ago. It would have to have as many years at 6% as those below or above as those below 4% and below, if you imagine a sort of normal distribution bell curve. That's not happening, folks. Zoom out and our economy looks better than Japan's in terms of prospects, but not markedly different. The stock market's lagging behind. One large American company is the size of the FTSE. Our people are getting older, and the only other magic pill that will work, because the birth rate has already collapsed, immigration, is a significant political football. This is not an economy that will average a base rate of interest of 5% or anything like it over the next 30 years. So what? Well, the one thing I was delighted about in the aftermath of Liz Truss was that the bank was stepping in to buy £60 billion worth of bonds at these sort of levels with long durations. What great timing. For once, we were actually, as a country, buying high to sell low a bit later on, which we did. That's phenomenal. The problem in many ways is that the profit that we made came from the pension funds, which leaves the pension funds a bit worse off. But the pension funds are so much better off because of where the interest rates are at today. That has balanced itself out, or at least balanced itself out. So if you think about the yield curve, remember what the yield curve is, right? It plots the yields of all the bonds of increasing durations as you go along the curve. The base rate sets the starting point for the yield curve, but the further you get away from the starting point, the less influence that the yield curve has. The less influence on the yield curve that the base rate has, So 30 years on, today's base rate really should have very little relevance at all. So what? Well, the so what is, instead of selling bonds at a rate of knots, how about selling shorts and replacing them with longs, as and when the longs are at a higher rate than the shorts? So do you see what I'm saying? You could sell some of your 5-year bonds at 4% if you're getting 4.8% over 30 years. Yes, it becomes a bet on the economy. Yes, look, it arguably isn't even for the Bank of England to do, although you'd want to do it with the Treasury's money. But let's say I could sell a 2-year bond at 4.5% yield and buy a 30-year bond at a 4.8% yield. That trade has been possible, right? I've made money in the first place. I'm in a position as a government agent to hold that bond to maturity, and I, and therefore we, the taxpayer, are benefiting from not paying that 4.8% yield to others, but keeping it in-house. So the arguments against this get a little bit nuanced. We did need to lower our money supply. It's still rising, by the way, but QT has made some difference. Some. However, creating profit rather than loss from this situation would ease the need to raise taxes or debt to pay for the losses that have been made instead. Here's the tale of the tape in terms of what's actually happened. And the last time this was properly reported on was a report from last year. We're due another one, but we won't get it until after the election. This is from the Office for Budgetary Responsibility. Since quantitative easing, QE, the purchasing of government debt and other assets financed by the issuance of central bank reserves, was introduced in the wake of the 2008 financial crisis, central banks around the world have made large profits on these interventions. This is because the interest they pay on the reserves that finance QE asset purchases has been lower than the interest received on those assets for much of this period. In the UK, by March 2022, this had allowed the Bank of England to transfer £120 billion of cash profits on the APF, which is the asset purchasing facility, to the Treasury, which receives both the profits from and indemnifies the bank against any losses on the APF. So, 120 billion up in March 22. You'd think it would have been time to leave the casino, wouldn't you? But of course, the problem with this game and the rules of this game, you're not allowed to just leave. But you are the government, so you could change the rules. In recent months, as bank rate and other market interest rates have risen, and remember this is from March 23, and so market prices for government debt held by the APF have fallen, these profits have turned to losses from two sources. Interest losses, as the variable rate paid on central bank reserves exceeds the fixed rates paid on the assets purchased over the past 14 years. In the UK, mainly gilts. Valuation losses, as the market value of the roughly 820 billion in gilts still held in the APF has fallen below the purchase value by about 165 billion. These mark-to-market losses only crystallise under the Treasury indemnity as and when gilts are sold, which is what I've been saying. If you let them expire, then we don't make a loss, right? If you sell them into the market to a third party, we make that loss. That is the difference, right? So here is the forecast at this point. Nonchalantly reported, really. Interest gains / losses. In the 13 years to the end of 21-22, the APF had received 175 billion in interest on those assets and paid 22 billion in interest on the reserves issued to finance those assets, yielding a net profit of 153 billion for the public sector as a whole. From 22-23 onwards, this reverses as the interest rate on reserves rises above that on gilts and other assets being held, yielding a net loss that peaks on an annual basis at 17 billion in 23-24. The net loss then declines across the forecast as bank rate falls back and the volume of assets held in the APF decreases. Total interest losses, and so borrowing, summed to 46 billion between 2022-23 and 2027-28. And then crystallised valuation gains. And so we're losing 46 billion, according to that forecast, in those 5 years, based on the fact that these bonds that we've already bought. So bear in mind, we've given back a bit, but we still had 120 billion of profits, and we would have had to give back another 46. Still not ideal, right? But then, crystallised valuation gains losses. In the 13 years to the end of 21-22, 29 billion of valuation losses had crystallised in the APF, so they'd sold off some bonds already, right? These losses increased across the forecast to a total of 61 billion, as gilt prices on sale below those at which those gilts were purchased added to losses crystallised on gilts that are redeemed at maturity. So, what are we saying there? There's another 61 minus 29, so we're talking another 32 billion quid because we're insisting on selling some of these bonds that we shouldn't be selling, in my opinion. 32 billion quid. And that was just the forecast. In March 23, the bond yields were actually quite low, so it's got worse since then. But as I say, real-time figures, quite difficult to get on all of this stuff. So, note their figure from that first bullet point is way lower than Reform's figure, because Reform was saying 30 to 40 billion a year. They're saying 46 billion over a 5-year period. Why? Well, I'll tell you why. Someone at Reform just Googled it and used the highest figure that they could. That figure came from October 2022, when base was going to hit 6.5 and was never right. It was just markets panicking at the time. Yeah, seriously, that's how Reform have done what they've done there. But nonetheless, still, use my methodology to change the system and cut those losses significantly. Why not? Bank share prices would go down and some pension funds would suffer as a result. That is true, but it's not the main driver. The main driver is a lack of people within the system who are willing to be difficult, disruptive, and drive things forward that would benefit all of the people, the taxpayer, rather than special interest groups. Does that change with the Labour administration? You'd like to think so, but I wouldn't get hopes up too far. There won't be too many people who understand this. I would expect that Rachel Reeves would understand it very, very well and would be able to add some value to this message, and it would be brilliant if she watched this video, to be honest. So, that 32 billion to be saved if losses weren't crystallised. Maybe it's just me, but I'd want a pretty bloody good business case to justify that 32 billion, and I don't think there is one. My methodology would have, and would, make money instead of losing it. It needs refining. It isn't the answer, but surely to goodness it's a pretty good basis for a discussion. The kicker, isn't it nice when you've got a parachute? Combining interest and valuation losses, total cash losses amount to 108 billion over the forecast, almost reversing the 124 billion cash profits to date. The APF is assumed to call on the Treasury for most of this loss within the forecast period, including debt, increasing debt excluding the Bank of England by 103 billion. Now look, yes, on that forecast we still would have made a profit overall, but that's not the point. That 124 billion that was in the coffers back then, that was already allocated, spent. It wasn't kept in a separate pot somewhere. It wasn't saved. It wasn't invested. It was just spent on public spending. So it's already gone, right? So this is more stuff that's needed in the real time. So that right there, folks, is why the public sector will never outperform the private sector or get anywhere near. 100 billion down. Oh, okay. Who's picking up the tab? Number 11. Ergo the Treasury, the taxpayer. It honestly makes me sick. What specifically? The fact that we don't even try. Right? There's another way. And this week, I'd like to ask for a special effort in terms of likes, shares, spreading the word. I'd love to be involved in making a difference to benefit the country rather than sitting and moaning about it, as so many in the media or on social media seem to do, which you could also include me in this video, let's face it. But anyway, if you can put this in front of someone who you think will make sense of it, who will listen to it, I'm very, very willing to give up some of my time and put some effort into making a difference. Well done, as always, for getting to the end. And please remember those last few tickets for the next property business workshop, Thursday the 4th of July, bit.ly/PBWTHREE. And look, there's only one way you can continue to do all of this noise, all of this election nonsense, and that macro overload that I've just given you. Keep calm, always tune into the supplement, and carry on. Thank you.